Hello, everyone. Welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wainman. So today, we're going to be looking at a pub business. I think it's the first time we've looked at it for this particular podcast, and really excited to do so. And as you know, pubs, hospitalities were severely affected by the pandemic and the lockdown. So this will be an interesting one for us to view to see, do the finances or the latest finances actually show any of that? So stick around for that. So just to give you an idea of JD Wetherspoons, which is what we're going to be looking at. So JD Wetherspoons, founded in 1979 in an area in the UK called Watford. So as of June 2021, they operated 925 pubs around the country. And that actually includes 50 Wetherspoon hotels. Actually, I didn't realize that they had hotels. So that was an interesting find. So one of the things that is important to know is context before we go into the finances. So firstly, 6 months ending the 23rd of January, 2021. So like-for-like sales were down by 11%, right? So a significant drop for a business like that. And when you look at the share price, and stick around because we're going to show you what that looks like and give you some context based upon its finances. They went IPO in 1993. With the benefit of hindsight, if you had invested back then, you'd be sitting on a profit of 1,900%. But in the last 5 years, it has been down. So stick around. We're going to look into that. And what great news for this video is that this was a request from one of our viewers. Tony Jones, here is your video. Thank you for your request. Interesting to see your notes there. And again, if you have a company that you would like us to analyze for you, do leave a note in the comments section and leave, as Tony has done, leave some context behind why you're interested in looking at that company, because then we can account for that and include that within our own analysis. And again, of course, like, share, subscribe. Don't forget, we're not a financial, we're not investment advisors. We're not here to give you advice on your investments, etc. We're an education platform, so we're here to help you better learn and understand how to read financial statements and draw some analysis from that and improve your financial acumen. So Ted, take it away. Let's share what we found out about this company with our viewers.
Yeah, good to see you, Moeed. So absolutely, JD Wetherspoon, more commonly known as Spoons, a favorite haunt of my kids. And they pride themselves on, selling cheap beer. That's what they're very, very good at. And so all the kids are off down at JD Wetherspoons. Apparently a carpet in every pub, and a different carpet. So they have different patterns in every pub. And that's one ways you can recognize that you are in a JD Wetherspoon pub. The name, interesting enough, Moeed, I understand comes from, so Tim Martin is the chairman and was the founder. He was told by his geography teacher, you will never amount to anything. And his geography teacher was called JD Wetherspoon. So he set up his pub chain, named it after his geography teacher, and has now built a company which is worth over £1 billion. So yeah, he gets the last laugh. And I quite like JD Wetherspoons because Tim Martin, those of you who know him, he's a very straight talking individual, and it's kind of shown in his accounts. So here are the accounts, and these are very straight talking accounts. So we've seen some accounts where you can go on for days and days and days scrolling through trying to find the financial statements. Well, these guys, it's a 98-page document, and you're on the income statement on page 17. So there is very little kind of fluff and kind of wonderful, and pictures of board members and all that kind of stuff. It's just like, let's get into it. So here we have JD Wetherspoon for the 52 weeks ended July. So their year end is July 2021. Here we are, beginning of 2022. So these are reasonably recent numbers. Now, having said that I like these accounts. I'm always a little bit nervous about these exceptional items, because exceptional items, you'll notice, happen on a fairly regular basis. So I'm not going to focus too much on that. I'm really going to focus on the total, which is this column here and this column here. So these are the numbers we're really going to be looking at and comparing like with like. What's happened to the revenue? Well, you mentioned an 11% drop. Well, from 2020 to 2021, or 2019-20 to 2021, revenue is down by 40%. Okay, so pubs were closed, pandemic, and this was absolutely, I mean, this just crippled the business. They've managed to get their operating costs down. So 1.2 billion, they managed to reduce them down to about 900 million. But, you know, they're going to have a lot of fixed costs in there, you know, leases, rents, for example, of properties they don't own, you know, staff costs, you know, even if they're being furloughed. So, you know, this is really, you know, the whole pandemic has really killed them. So I think you're going to find that this loss in 2020, that's going to include the kind of the first lockdown, you know, which was devastating for them, and then just continued lockdowns and social distancing and mask wearing and all this kind of, you know, it's you know, and if you speak to Tim, you know, he'll just say it's been killing the pub trade. So these guys, you know, have really struggled as a result of that, and it's showing through on those numbers. But there's no reason why, as we reopen, you know, if we look at the number for next year, which is blank, obviously, there's no reason why it shouldn't start to improve. It's not going to be perfect, because even since July 2021, they've had lots of lockdowns and kind of, you know, and you know, it's been difficult. But we are, you know, we're starting to get a sense that, you know, we've got the end of the pandemic in sight, that we're learning to live with the virus, and that this should return to reasonable profitability as before. If we look at the balance sheet, interesting enough, the balance sheet comes a little bit later on. So here's the balance sheet. Now the comment, our friend who asked for this was talking about their investment property. So this is where the investment properties sit. So all of their properties, you'll notice they got about 1.4 billion pounds worth of property, and that's really the kind of, you know, those are the assets. There's also quite a lot of right of use assets. So this is going to be things like, I know, a point of sale machine, and they rent it rather than buy it, for example. And a bit of investment property. This investment property will merely be property that they own, but they don't use as, you know, effectively for their pub. So maybe they bought it and they've let it out to somebody else. Non-current assets, you know, very high. So 2 billion pounds worth of you know, stuff that they need to run the business. A little bit further down, we've got the current assets. I'm just going to scroll down a little bit further so we can see all the numbers. So current assets, 45 million in cash, down from 175. Well, they've been burning cash during the pandemic. Their inventories, you know, this is going to be, you know, beer barrels, for example, and nuts and all that kind of stuff. A little bit of receivables. You know, not many people buy their beer on credit, but, you know, they'll maybe kind of, you know, hotel, for example, hotel bills, etc., etc. Now, what is worrying about this is this number here, these current liabilities. So these current liabilities is mainly the trade and other payables. Okay, and it doesn't take a rocket science to say that if you've got 92 billion of current assets, which are things which are going to become cash soon or already are cash, and you own 260 billion, then you have a potential liquidity problem. You'll notice in the previous year, the ratio was much healthier. Now, do remember, these guys are, you know, they're a cash-based business. So you go into a pub, you're buying stuff, so they're getting the cash in, and maybe they're able to kind of pay their suppliers a little bit further down the line. They pay the staff at the end of the month, but, you know, that is still, you know, that's a massive difference on the liquidity. So it wouldn't surprise me if they need to kind of shore up their finances, or maybe they already have. I have to admit, I haven't actually checked the market as to whether they've actually gone back and tapped the shareholders for a little bit more cash. And I probably would, I'd be happy to do that if I was a shareholder, because I think that, they are going to come back after the pandemic. But you can start to see that, the pandemic and the strain it puts not only on the profitability but also on the liquidity of companies such as JD Wetherspoons.
So just to check, Ted. So the 91 million in total current assets, you pointed down to the 260 in trade and other payables, but if you actually compare the current assets with the current liabilities, it's kind of higher, isn't it? Because it's 335 million. Yeah.
You're absolutely right. So I highlighted this as the kind of, these are your suppliers who are expecting to be paid. And obviously, if you run a pub and you stop paying your suppliers, they stop supplying you with beer. You can see that, your business is going to fall apart pretty quickly. These are the lease liabilities. So if you've got lease payments that you need to make, if you don't make your lease payments, they'll come and close your pub. So, both of these are big numbers. So yeah, you're absolutely right. We're looking at this 335. They are important numbers. The borrowings, well, maybe you can go back to the bank and you can refinance. So you can kind of maybe just say we don't have to worry about that so much, as long as we can convince them to allow us to refinance. But that you depend on the goodwill of the bank there. And then we go down to our non-current liabilities. There's the rest of the debt. So they do have these they do have their properties, but they've got debt sitting alongside that. So they've borrowed money in order to buy their pubs, and then they're going to have some lease liabilities. So this is on their leased assets. This is the amount that they owe. So we take these two lease liabilities here, we put them together, and we can compare them to the leased assets. Let me just scroll back up again and show those, what we call those right of use assets, the 468. So these are kind of, almost a kind of a matching process. And effectively, there's just, the net assets, there's not a lot of net assets in this business. So, it's 300 million is a reasonable amount. But, these guys, they've got a lot of property, they've got debt sitting alongside that property, and they've got a liquidity issue going on in the middle. And that's kind of reflected in their equity, this section down here. And you can see the retained earnings. They've gone from retained profits down to a retained loss. So that big loss in the year, 181 million pounds, has just really hammered the equity in the business. And so we can see, that the share capital and share premium, they're consistent, so they're not tapping the shareholders for any more money, but they have seen this just this big hit in the equity, and they really can't afford to do that too many more times. And so you will often hear Tim Martin in the news just really berating the government for their lack of understanding and lack of help with the business. Here's the cash flow statement. Now, really like the cash flow statement, and the reason I say I like the cash flow statement is because of this column here, free cash flow. Now, we don't talk a huge amount about free cash flow, but just for those of you who aren't sure, so cash flow is kind of just looking at cash flow in the business. Free cash flow is trying to look at your cash flow after replacing your existing assets without investing in new assets. So, for example, if we're thinking about JD Wetherspoons, they may have a pub. The pub's carpets are worn out. They need to replace the carpet, okay? And so they spend money, capex, on buying that new carpet. That's what we would call replacing existing assets, okay? But then there's a new pub down the road. They want to put a carpet in there. That would be investing in the future. That's a new asset. So it's worth kind of just realizing why they're doing this. So what they're trying to do is to show, well, first of all, they are making they're making a loss from their cash operations. So this number here, they are making a loss. They were generating cash the previous year, but and don't forget, they're making a loss of 181 million in the income statement, but only 35 million in cash. Okay, so it's not the end of the world. They got 45 million in cash in the balance sheet, but I think that they will be negotiating with their suppliers. They'll be negotiating with their leaseholders. They'll be trying to defer payments, and that would have been helping them in terms of their cash generation. So what you see down here is this net cash flows from investing activities, this section here. So the total amount of investment is 57 million. And what this is really saying is that 22 million is maintaining the existing pubs. So you can see here, it's kind of the reinvestment in pubs. And while here, we've kind of got the investment in new premises. Okay, so they are spending money on new premises. They're kind of, there's opportunities out there. They're still trying to expand. That's what they've got to keep on doing. So they can't just hunker down and do nothing. So they are investing in the future, and then you can see this kind of how they're funding it through this through issue of share capital, etc., etc. So they've got the issue of share capital, and this is really, again, they're highlighting this to say, look, what we're basically doing, this is all about investing in the future rather than just maintaining our existing stock. And so the summary is that they, their cash has gone down. Their cash has gone down by quite a lot as a result. So again, free cash flow is less relevant. So they're showing it here. So they start with 175 million in the bank. They finish with 45 million. It's gone down by 130 million, and that is why. So they've lost 35 million from their trading operations. They've spent 60 million investing in existing pubs and in the future, and their financing has cost them another 36 million, hence the fall in cash. Obviously, if you're running a business that burns 35 million a year and you've got 45 million in the bank, it doesn't take a rocket scientist to realize that that is not a sustainable position. And again, that is something which Tim Martin is very, very conscious of. So I guess the kind of the summary for these guys is, and I go back to our original comment. I can't comment on the sort of the value of those investment properties. So the comment was very much, let's just go back to the balance sheet. Here is the balance sheet. The comment is really surrounding around these this note 13, these investment properties, and really saying, look, are they undervalued? Well, if we go to the bottom half of the balance sheet, you'll notice down here the shareholders' equity. There's no specific revaluation reserve. Now, I don't know what their policy is regards to those investment properties, but it's quite possible. And it is quite possible that that is what they paid for those properties, and if they paid for them, many years ago, they will be worth substantially more today, and therefore, on a net book value, a net asset value, then this company is worth a lot more than the book value it's currently sitting at, which is this equity of about 278 million pounds. Okay, so there is that kind of that potential of an undervalued company. However, don't forget, if you're an investor, what you're really doing is you're buying the income stream. So it's almost like it's not what the property is worth unless you're trying to go for that breakup value. So that's where you may have a company come in and say, actually, JD Wetherspoon is worth more on a breakup basis. We buy the company. We'll look at the share price in a minute. We buy the company. We sell off all of the pubs, at their market value, and we bank a whole lot, But that's a kind of that's not something we're going to get through these financial statement analysis. Here's the movement in equity, just to kind of show what's been going on. And you'll see here in 2019, they were paying dividends, and they were buying back their own shares. So, life was good. We're making profits, and things are rocking along. And then we get to the kind of, into this year, and there's no dividends being paid. They are buying back their own shares, but they are, that's this number here, but they're not paying out any dividends, really, because they just can't afford to. So they kind of need to hold on to all the cash that they can to sort of survive it. I'm not going to go through all of the notes, but I did sort of, jump out this one. Sort of, I found quite interesting. So this is the breakdown of their revenue. So you can see the kind of the takings at the bar. So this is the beer that they sell and the food that they sell. So the bit, both of those are down. The eat out to help out, they've highlighted it as a separate. They kind of just said, this is a separate income stream, and obviously you're not going to see that next year. So they're kind of again making a little bit of a political point there. And I thought this was quite interesting. Slot machines. Look at, with people not going to the pub, they were earning 36 million pounds from slot machines. Now that's a fairly substantial amount of money, and that's gone down to 17 million pounds. And if you play the slot machines, that's effectively the net profit on those slot machines, which means that you're going to lose if you gamble. Okay. So I thought that was quite an interesting, little analysis in there. So having a look at their share price. So if we go and have a look at the share price, let's just pull that up again for us. Here we go. So the share price is 885 per share. So market cap down the bottom, I've circled it, 1.14 billion. 1.14 billion pounds. So just to kind of put that into context, if we're trading at sort of 1.14 billion pounds, and the net assets, if you remember, about 300 million, they're still a fairly substantial. So the market cap, it is trading at a significant premium to the net asset value. So go back to our requester. I think it was Tony Jones who said, what about the investment properties? That looks like it may already be baked into the price. So in terms of JD Wetherspoon, it's already trading at a significant premium to the underlying net asset value. So even if the properties are worth twice as much as they got on the books, you're not going to be able to buy the company and then break it up and sell the individual assets for more than you actually paid for it. In terms of, there's no P ratio, there's no dividend yield, because they're not, they're not making any profits, and they're not paying out dividends, and therefore, that's a little bit of a sort of head scratcher. So where does this company go from here? Well, we very clearly see, there's the pandemic that hits, and all shares take a hit, but then people like, I don't know, Peloton, for example, we looked at recently or a while ago. So Peloton, everyone goes, oh, everyone's going to be staying at home and on their exercise bikes, we'll buy Peloton. So Peloton bounced back very, very quickly. But of course, right now it's in the doldrums. It's really, really struggling. Okay, maybe JD Wetherspoon is the other way around. Maybe JD Wetherspoon doesn't bounce back very quickly because everyone sort of realizes that, pandemic, everyone's staying at home. These guys are going to really suffer. And you can see that kind of sinking in, and it's down, but you start to open it up. People want to get back out into the pubs. They want to have some fun. There's no reason why it shouldn't, we take a kind of pre-pandemic, where is it going? There's no reason why it shouldn't return to that. Okay, and maybe you're still sitting there thinking, actually, there's a value gap in here for it to return to normal. So maybe there's an opportunity to buy a, whatever it is today, and see it kind of, actually increase onto that kind of that, and that's a chartist view. So there's no sort of fundamental kind of value analysis. That's what we call kind of slightly more momentum, where it returns to its previous growth. Will that work? Who knows? But it certainly doesn't look like it is. I don't know. I mean, it doesn't scream, don't touch this with a barge pole. It's way too expensive. There's not a lot of hype, I think, sitting in JD Wetherspoon's. So, but it might be quite an interesting play for somebody who wants a little bit of a kind of little bit of risk on, let's say, but isn't in that kind of I need a sort of 50 bagger fly by the seat of my pants kind of tech jam tomorrow company. This is very much jam today. It just it's just run out of jam because nobody's going to the pubs. But they'll come back. You know, if I go down to my local JD Wetherspoons down the road here, you know, it's pretty packed of kids on a Friday and Saturday night. You know, they'll make money. It's a good formula. You know, and it works. And I think Tim Martin is pretty sanguine about it. Now, just before I finish, Moeed, I do want to just highlight this. So if you go onto their website, and again, this is kind of, I mean, this is Tim Martin through and through, it really is. But if you go onto their website, you can actually get their latest trading update. So this is dated 19th of January. Here's their trading update. And it just sort of says that, you know, we're gonna tell you what the numbers are, and I think this is where you got your numbers, 11% decrease, for example. But what I love about this trading update is it then goes on about Partygate. So those of you based in the UK will be very familiar with this, about, you know, all of this kind of you know, the government have been you know having parties while everybody else was in lockdown, and this is, you know, this is just basically Tim Martin having a big old rant at the government about, you know, this is totally unacceptable. And then there's a good rant against BlackRock about you know, who's one of their largest shareholders, and BlackRock saying that they're not sure about the corporate governance within JD Wetherspoon's corporate governance. The CEO and the chairman should be separate, but they aren't for JD Wetherspoon's. And Tim Martin just holding up the mirror to BlackRock and saying, hey guys, look in the mirror, you have the same problem as well. And a few other points about VAT and Outlook, etc., etc., etc. So I just thought that was quite a nice, you know, a trading update, which really wasn't. It was more of a rant than a trading update. But put a smile on my face anyway. So yeah, we like JD Wetherspoons. Is it a buy? I don't know. Again, it probably would not be out of place in a well-diversified portfolio of investments, Moeed. And there, I will leave it with you.
Okay, well, there you have it. Love to hear everyone else's thoughts on that, actually. So if you have any perspectives on this industry, particularly in the UK, if you come from the industry and know it very well, we'd love to hear your thoughts, and do share those in the comments. This is a community at the end of the day. So until the next video, thank you, Ted. Thank you, everyone else. Please keep your requests coming in. We will try to publish and analyze your request as fast as possible. We do get a lot of these now, but please send in your requests. So till next video, thank you very much, everyone. Thank you, Ted.
Catch you later, Moeed.